So we've looked at some of the basics and we've looked at some history of Japanese candlesticks. The next step is to introduce the advanced candlestick patterns, and then we're going to test them on our historical database to see which ones work. And at this point, you might want to download or print out the candlestick poster that comes with the course so that you can see which patterns we're going to look at. And you'll find the poster located later on in the course documents. But before we get into the test results, we need to clear up a bit more of the boring stuff because we need to be clear about a few things regarding the testing procedure and how we will be defining the candlestick patterns. So first of all, it's important to address one of the quintessential problems with all candlestick patterns, which is subjectivity. So when researching this course, I soon realized that nearly everybody has a different interpretation of what makes up a specific candlestick pattern. For example, some authors say that a shooting star pattern must form in an uptrend, but how do you define an uptrend? Also, some say that a hammer pattern must have a long lower shadow, but exactly how long should it be? There are numerous occasions like this where the definitions are vague and it's difficult to be precise about what should make up a specific pattern. In fact, look at any technical analysis book or blog post and you're going to come across different variations for nearly every candle pattern there is. Because of this, I had to come up with some standardized definitions for each candlestick pattern. And because I wanted to be able to test each pattern on historical data, I needed a precise mathematical definition written down in code. So to cut a long story short, the formulas I've come up with are based upon three sources: Candlestick Charting Technique by Steve Neeson, the Bloomberg Visual Guide for Candlesticks, and on a couple of occasions I've also used Investopedia. The reason why I needed more than one source is because sometimes I would program a candlestick pattern in from one source and it would actually lead to virtually no trade signals. And sometimes the definition was simply too vague or too subjective. So I decided to use the pattern definition that gives us the most number of trading signals or the best performance overall. Having more signals gives us more confidence in the results of the pattern. So there isn't a great deal of use in testing candlestick patterns that are so rare they result in hardly any trades. On occasions though, you will see that some of the popular patterns are actually very rare signals, and so I've kept them as they are defined. As you will learn as we go through each candlestick pattern, some are useful, some are simply not worth looking at, and some actually work better in reverse. So, as mentioned, I created precise formulas for each candlestick pattern and then I wrote them into code. The code I'm using is AmiBroker AFL, and this is because my backtesting program of choice is AmiBroker. AmiBroker is an extremely powerful, flexible and affordable simulator that allows you to test various strategies and patterns on historical data, and I've been using it for several years now. So I've coded each candlestick pattern into AmiBroker code so that we can test those patterns on historical data. And each formula contains some abbreviations which are used to keep the code clean and easy to use. Where you see the letter OHLC, well, that stands for the open, high, low or the close price. And when there's a number that comes after that corresponding letter, that means we're looking at a previous bar. So O1 means we're going to be looking at the open from the previous bar, while H2 refers to the high from 2 bars ago, etc. And we need to reference these previous bars in order to be able to calculate the patterns properly, particularly the 2 candle and 3 candle patterns. Seeing as many candlestick patterns are meant to occur in uptrends and downtrends, I also had to come up with some objective definitions of what makes up an uptrend and what makes up a downtrend. Most sources suggest that the up and down trends do not need to be very long. So I decided that an uptrend would be defined as any time there's a new 10-day high on the bar, and a downtrend would be any time that there's a new 10-day low. Since some candlestick patterns cannot feasibly occur at the same time as a new 10-day high or low, we also need to be able to move the uptrend or downtrend back 1 or 2 bars as well. So I've used the numbers 1 and 2 to denote uptrends and downtrends that are going back a bar. So, for example, the 3 white soldiers pattern consists of 3 white candles with higher lows, taking place in a downtrend. We need to reference the downtrend 2 bars back because the third candle in the pattern needs to have a higher low, and therefore it automatically wouldn't fit the definition, our definition of a downtrend. If that's confusing, don't worry, it should make more sense later on. For now, just understand that the formulas have been created to identify the patterns objectively as closely as possible to the original sources. They may not always be perfect definitions because there's subjectivity by default, but now we do have the formulas, we can test the patterns on the data.